In this lesson, we will learn about capital structure optimization. Definition and importance. Capital structure refers to the mix of debt and equity that a company employs to finance its operations and assets. In the context of M&A, optimizing the capital structure is critical for achieving financial efficiency and strategic deal objectives. It balances the cost of capital with the return on invested capital, ROIC, ensuring that the financing cost remains below the ROIC, which creates value for shareholders. Deal feasibility. The fundamental principle is that the cost of financing the deal must be lower than the ROIC generated by the acquired company. In other words, ROIC must be greater than financing cost. If the ROIC exceeds the cost of capital, the deal creates value by generating higher returns than the financing costs. Conversely, if the cost of capital exceeds the ROIC, the deal destroys shareholder value because the acquisition costs more than the returns it generates. Therefore, determining the optimal capital structure requires a meticulous analysis of the target company's financials, growth prospects, and risk profile. Cost of capital. The cost of capital is the price a company pays for the funds it uses to finance an acquisition. This cost varies depending on the source of financing, whether it's debt or equity, and the specific financing vehicle employed. Cost of debt. This is the interest rate a company pays on its borrowings. In M&A, it can differ depending on whether the acquirer takes on the debt directly or uses a special purpose vehicle, SPV. Cost of equity. This is the return required by equity investors to compensate them for the risk they take. It can also differ depending on whether it's the acquirer's own equity or comes from external investors like private equity firms. WACC. The weighted average cost of capital. To determine the overall cost of capital, we use the WACC formula, which takes into account both debt and equity components. WACC is calculated by multiplying the cost of equity by the proportion of equity financing, adding it to the cost of debt multiplied by the proportion of debt financing, and then adjusting for the tax deductibility of interest. WACC equal E/V Ray plus D/V odd 1 TC, where E is market value of equity, the total market value of the company's shares. D is market value of debt, the total market value of the company's debt. V is total value of the company, E plus D, the sum of the market value of equity and debt. RE is cost of equity, the return required by equity investors. RD is cost of debt, the interest rate on the company's debt. TC is corporate tax rate, the tax rate the company pays on its profits.